The IRS has updated the rules, and most precious metals dealers are not going to explain those changes to you. Not because they are hiding something or trying to mislead you, but because dealers are not tax advisors. They are not required to teach you what changed. Their job is to process the transaction and file the forms the law requires. If the law says they do not need to file a form for your silver sale, they usually say nothing, even if you could still owe a large tax bill. At the same time, the Form 1099-B reporting rules for precious metals have shifted. The thresholds that decide which silver transactions trigger automatic dealer reporting to the IRS have been clarified, and in some cases narrowed. Some silver products that used to trigger a 1099-B may no longer require one. Other products that many investors thought were completely exempt may now fall into a gray area, and the gap between what your dealer reports and what you are legally required to report yourself has become wider and much more dangerous to misunderstand. In this video, I am going to walk you through the updated Form 1099-B reporting thresholds for silver. I will show you which silver transactions may trigger dealer reporting and which ones generally do not. I will explain the critical difference between dealer reporting and your personal self-reporting duty, and I will cover the 3 rules that your dealer will almost never warn you about, because those rules are not their responsibility. They are yours. I am not a CPA, and I am not a tax attorney. This video is for education only, not tax advice. The rules discussed here are based on IRS instructions for Form 1099-B, IRS Revenue Procedure 92103, and reporting or analysis published by CoinWeek, Scottsdale Mint, Bullion Exchanges, Atlanta Gold, Coin Buyers, CBS News, and other industry sources referenced in the original discussion. Before making any tax decision, speak with a qualified tax professional. This is Bridgeport Finance Channel. Let's go through these updated silver reporting rules step by step. Let's begin with how Form 1099-B works in the precious metals world, because this is where most of the confusion starts. Form 1099-B is a tax form used by brokers or dealers to report proceeds from the sale of certain assets. In the precious metals market, dealers are required to file Form 1099-B only when a customer sells certain products in certain quantities that meet specific reporting thresholds. The most important point is this: the IRS does not base precious metals reporting on the dollar value of your sale. It is not about how much money the transaction is worth. It is based on the type of metal, the purity of the metal, and the quantity sold. That is what determines whether a transaction is reportable. So, for example, you could sell $50,000 worth of silver and no Form 1099-B is triggered if the product and quantity do not meet the reporting threshold. On the other hand, you could sell a much smaller amount in dollar terms, and a 1099-B is triggered because the product and quantity do meet the threshold. This is one of the biggest mistakes silver investors make. They assume the reporting rule is based on value. It is not. These thresholds were originally designed to reflect the deliverable contract sizes used in professional futures markets, especially the standards recognized by the Commodity Futures Trading Commission, or CFTC. In simple terms, the IRS used futures market standards to help decide which physical precious metals transactions are large enough or standardized enough to be reportable. The IRS instructions for Form 1099-B explain that a precious metal sale is generally not reportable if the metal is in a form that the CFTC has not approved for trading through a regulated futures contract. And even if the metal is in an approved form, the transaction is still not reportable if the quantity sold is below the minimum size required to satisfy that kind of futures contract. That is the foundation of the entire system. Precious metals reporting under Form 1099-B is product-specific and quantity-specific. It is not dollar-based. And that framework has now been clarified in ways silver investors need to understand. Here are the current reporting thresholds and interpretations that matter for silver. Let's start with silver bars and silver rounds. Historically, the reporting threshold was 1,000 troy ounces of 999 fine silver in a single transaction. But updated industry guidance, as discussed in the original transcript, suggests that some dealers are now interpreting reportable dealer reporting to apply specifically to 5 or more 1,000-ounce silver bars, or about 5,000 troy ounces total. If that interpretation is followed, then the reporting threshold for many bar transactions is effectively higher than a lot of investors realize. For the average retail silver investor, that is a very large amount. If you sell 500 ounces of silver bars to a dealer, no Form 1099-B would generally be filed under either the older threshold or the newer interpretation. In practical terms, this means many silver bar sales remain outside automatic dealer reporting. Now let's talk about 90% US silver coins, often called junk silver. This is where the biggest reported change has taken place. Historically, dealers were required to file Form 1099-B when a customer sold $1,000 or more in face value of pre-1965 US silver dimes, quarters, and half dollars. For years, this was one of the best-known reporting thresholds in the silver market. But under the updated guidance referenced in the original transcript, some industry interpretations now suggest that 90% US silver coins may no longer require Form 1099-B reporting at all. That is a major shift. Let me say that again clearly. Junk silver, which used to have one of the lowest and most familiar reporting thresholds, may now be entirely exempt from dealer 1099-B reporting under the current interpretation many in the industry are following. That is a big deal because many investors still believe junk silver automatically triggers reporting above the old threshold. Under the updated understanding, that may no longer be true. Next are American Silver Eagles. These remain exempt from Form 1099-B reporting regardless of quantity sold. This exemption has been recognized for decades. American Silver Eagles were not included on the original IRS list of reportable items, and U.S. coins minted after that reportable items framework was created have generally remained outside those reporting requirements. So if you sell Silver Eagles, the dealer usually does not file a Form 1099-B based on quantity alone. To make this easier to understand, here's the broad comparison. Silver bars and rounds made of 999 fine silver, generally reportable only above certain large quantity thresholds, with some updated interpretations pointing to even higher quantities than many investors expect. 90% US silver coins, also known as junk silver, historically reportable above $1,000 face value, but current guidance discussed in the original script suggests they may now be treated as non-reportable by many dealers. American Silver Eagles, generally exempt from Form 1099-B reporting no matter how many you sell. Fractional silver products, generally not reportable. Foreign silver coins not on the IRS reportable list, generally not reportable. Now we need to move to the 3 rules that matter the most, because these rules exist outside the basic Form 1099-B system. These are the rules your dealer is not likely to explain, and these are the rules that can cost you real money if you misunderstand them. Rule number 1, your self-reporting obligation has no threshold. This is probably the single most important point in the entire video. Whether or not your dealer files a Form 1099-B, you are still legally required to report every taxable profit you make from selling silver. There is no minimum dollar threshold for your own tax reporting. There is no minimum ounce threshold. If you sell 1 ounce of silver and make a $50 profit, that $50 gain is still taxable and must still be reported. This is where many investors get into trouble. They assume that if no 1099-B was filed, then nothing needs to be reported. That is false. A dealer's reporting obligation and your tax obligation are not the same thing. Silver is generally treated by the IRS as a collectible. That means long-term capital gains on physical silver can be taxed at a maximum rate of 28%. The narrower dealer reporting becomes, the fewer transactions get automatically reported to the IRS. But your duty to self-report every gain does not get narrower. It stays exactly the same. So the real danger is this. As dealer reporting becomes more limited, the gap gets wider between what the IRS sees automatically and what you are still legally required to report on your own return. That gap is where mistakes happen. That gap is where penalties, interest, and audit risk can begin. Rule number 2, the 24-hour aggregation rule. This is a rule many silver investors have never heard of, but it matters. Under the IRS instructions for Form 1099-B, a dealer may have to combine multiple precious metal sales made by the same customer within a 24-hour period and treat them as one sale when deciding whether the reporting threshold has been crossed. Here's what that means in plain English. If you sell 600 ounces of silver bars to a dealer in the morning and then sell another 500 ounces to that same dealer later that day, those transactions can be added together. Combined, that is 1,100 ounces. If the relevant threshold is 1,000 ounces, then the transaction could become reportable even though neither sale by itself crossed the limit. There is also an anti-avoidance rule, sometimes called an anti-structuring rule. If a dealer knows or has reason to know that someone is splitting transactions across different times, different days, or even different related people in order to stay below the reporting threshold, the dealer may still aggregate those transactions and file the form. That means trying to break up a large silver sale to avoid reporting may not work, and it may actually create more risk. Most dealers will not stop to explain this to you. They will simply follow the reporting rules if the transaction pattern requires it. Rule number 3, the 28% collectible tax rate. This is not a Form 1099-B rule. It is a tax rate rule. But for many silver investors, it is the most expensive rule of all because it is so often misunderstood. Physical silver is generally classified as a collectible for tax purposes. That means if you hold silver long enough to qualify for long-term capital gains treatment, you still do not get the lower stock market capital gains rates that many investors expect. Instead, your long-term gain can be taxed at a rate up to 28%. That is higher than the standard long-term capital gains rate that often applies to stocks, and many silver investors never realize it until tax season. Your dealer will not explain that tax rate when you sell. They are there to complete the transaction, not to give you tax planning advice. And here is where this becomes dangerous. If you sell a silver product that may now be exempt from Form 1099-B reporting, such as junk silver under the updated industry interpretation, you might assume the sale is invisible and therefore not taxable. But that is the wrong conclusion. The transaction may be invisible to your dealer's reporting duty, but it is not invisible to your own tax duty. If there is a taxable gain, it still needs to be reported, and if the gain is long-term, the collectible tax rate can still apply. There is one more area that catches investors off guard, and that is silver ETFs. If you sell shares of a silver ETF, such as SLV or SIVR, through a brokerage account, your brokerage will generally issue a Form 1099-B automatically. It does not matter if you sell 1 share or 10,000 shares. Brokerage platforms treat those sales like other reportable investment transactions, so the form is issued automatically. But this creates a trap. The Form 1099-B you receive from a brokerage account usually reports the proceeds and sometimes the cost basis, but it does not necessarily identify the transaction as a collectible for tax rate purposes. That part may still be left up to you. So when you import that 1099-B into tax software, the sale may appear next to your stock and bond transactions. If the software does not recognize that the silver ETF is treated as a collectible for tax purposes, it may apply the normal long-term capital gains rate instead of the higher collectible rate. That can lead to underpaying your tax bill and increasing your audit exposure. In other words, physical silver sales often do not trigger dealer reporting unless they are large and meet specific product thresholds. But silver ETF sales usually do trigger a 1099-B through a brokerage account, even though that form still may not apply the correct collectible tax treatment automatically. In both situations, the burden of getting the tax treatment right can still fall on you. There is one final part of this reporting puzzle that your dealer will not handle for you, and that is cost basis. When a dealer files a Form 1099-B on a silver sale, the form generally reports your proceeds, meaning the amount you receive from the sale. It does not automatically prove or fully establish your cost basis, which is what you originally paid for the silver. Cost basis is what you use to calculate your actual gain. This matters because if you cannot prove your cost basis, the IRS can challenge your numbers. In the worst case, a basis problem can cause far more of your sale proceeds to be treated as taxable gain than should be the case. For example, imagine you sold 1,000 ounces of silver at $85 per ounce. That gives you $85,000 in proceeds. If your true cost basis was $25 per ounce, then your actual taxable gain is much lower than the total sale amount. But if you cannot document what you paid, you create serious risk for yourself. Your cost basis is not just the raw purchase price. It can also include dealer premiums above spot, shipping costs, storage fees, insurance costs, and appraisal charges if they are properly documented and treated as part of your investment cost. Every legitimate documented expense that increases your basis can reduce your taxable gain. That is why record keeping matters so much. Keep your invoices, keep your receipts, keep shipping confirmations, keep account statements, keep anything that proves what you bought, what you paid, and what it cost to hold or move the silver. Good records can save you a large amount of money if your return is ever questioned. Now, let's bring everything together. The silver form 1099-B reporting landscape has been clarified and in some cases narrowed. The threshold for silver bars may be higher than many retail investors thought. The old reporting rule for junk silver may have effectively disappeared under current industry interpretation, and American Silver Eagles remain broadly exempt from dealer reporting regardless of quantity. But narrower dealer reporting does not mean lower tax responsibility. In fact, it can mean the opposite. It means fewer transactions are automatically reported by dealers, which means more responsibility falls on you to understand the rules, track your gains, and file correctly. Your dealer will file the forms the law requires, but they usually will not explain the 24-hour aggregation rule. They will not warn you about the 28% collectible tax rate. They will not track your cost basis for you, and they will not make sure your silver ETF sale is classified correctly inside your tax software. That responsibility is yours. And once you understand that, you begin to see the real issue. The biggest risk is not always the transaction itself. The biggest risk is assuming that a sale is non-reportable and therefore non-taxable. Those are not the same thing. A sale can fall outside dealer reporting and still create a real tax obligation for you. So the key lesson is simple. Know the difference between a reporting threshold and a tax obligation. Know the difference between what your dealer has to report and what you still have to report yourself, because that difference is where silver investors can lose money through penalties, interest, and taxes they did not prepare for. If this video helped clarify the updated Form 1099-B rules for silver, share it with another silver investor before they sell without understanding what has changed. Subscribe to Bridgeport Finance channel and turn on the bell. The forms may have changed. Your obligations have not. Know the difference. I will see you in the next video.